Okay, right, let us continue from where we left off. Now, the important points that relate to what we derived in the previous slide. The regression is with respect to changes in prices and not prices themselves. Please note that the regression is run between delta f and delta s. It is not between f and s. Delta f is the independent variable, delta s is the dependent variable. So, we are looking at some kind of a regression equation of the form delta s is equal to beta delta f plus alpha. That is the regression equation that we are looking at. The regression variable is delta f and the dependent variable is delta s. The second thing is we have not accounted for the integrality of the number of contracts. As I mentioned, the number of contracts are standardized. The number of underlyings that are covered by one futures contracts are standardized. You can take position in an integral number of futures contracts, you cannot take positions in integral numbers of units of the underlying. Futures contracts constitute the trading lot, the lot size. Trades have to be made in terms of the lot size, that is also known as the contract multiple. So, we have not accounted for the integrality of the integral nature of the lot size. Let us do an example and then we will proceed with the theory. Suppose that a very simple example to start with, very elementary. Suppose that the standard deviation of quarterly changes in prices of a commodity is 0.65. So, this is the standard deviation of spot prices, standard deviation of quarterly changes in the prices of the commodity itself, and the standard deviation of quarterly changes in a futures price on the commodity. We are having the same commodity and futures are available on that commodity, and the price changes, the standard deviation of the price changes is given by 0.81. The correlation coefficient between the two is 0.8. So, this is rho and he wants you to work out the optimal hedge ratio. It is quite simple. Optimal hedge ratio is given by H is equal to beta delta S delta F, and that is nothing but rho delta S delta F into sigma delta S upon sigma delta F. You put these values and you get the hedge ratio as 0.642. As you can see on this slide, rho is equal to 0.80, sigma s as we have just seen is 0.65 and sigma f is 0.81. Calculation gives us 0.642 as the hedge ratio, and by the definition of the hedge ratio is equal to QF upon QS. Therefore, the exposure or the hedge that we need to create in the futures market would be 64.2% of the hedge of the exposure that we have in the spot market in terms of the number of units. Another example, a slightly different example. On March 1, the spot price of a commodity is 20, that is S naught is equal, this is S naught is 20, and the July futures price is 19, this is F naught. Futures price on March 1 of a future which is going to mature for delivery in July. July is the delivery month of the futures contract, March 1 is today. So, this is nothing but F naught, and June 1 is the date when you plan to lift the hedge. The spot price goes up from 20 to 24, this is ST. This is ST, the spot price as on date of the lifting of the hedge, and the futures price of this July futures. Now, this example also makes it clear. The futures are going to mature in July, but you are lifting the hedge on June the 1st. So, you are lifting the hedge before the futures are going to be actually ready for delivery. So, as on that date, the futures price works out to 23.50. So, a company entered into a futures contract on March 1, that was T equal to 0, and closed out the position on June 1. What was the effective price paid by the company for obtaining the commodity? The effective price is given by F0 plus Bt, and that is equal to minus of F0 minus St plus Ft, or you can write it as minus St plus Ft minus F0. As you can see, this is the profit on the futures position, and this is the price that you are paying by acquiring the asset from the spot market. This is the cash outflow that you are going to make when you acquire the asset from the spot market. So, this is the price differential, this is the profit that you make on the futures contract, and this is the price that you pay for acquiring the asset in the spot market. Putting these respective values, what we get is 19.50. This is minus 24 is the price that I pay for acquiring the asset in the spot market. 4.50 is the profit that I made on the futures position. 19 has gone up to 2350. So, that is 4.50 the profit that I made on the futures position. So, my net cost has come down from minus 24, that is 24, to 19.50. Minus sign shows that it is a cash outflow. This is a similar problem. Here the important thing is that the exposure QS is given in terms of pounds of wheat, that is the quantity of exposure, quantity of the exposed asset is given in terms of the pounds of wheat that is to be covered by the hedge. If I put down these respective values from the problem, I arrive at a hedge ratio of 0.60, and using this hedge ratio I can work out QF, because hedge ratio is nothing but QF upon QS. So, QF is equal to 0.6 into QS. QS is given as 200,000, and therefore, QF works out to 120,000. And since one contract is of 40,000 units of wheat, 40,000 pounds of wheat, therefore, you have to take 3 contracts, you take a long position, because you want to protect yourself against a rise in prices. Now, this particular diagram chart gives you an analysis of the impact on the hedge, on the hedge portfolio of a change in the hedge ratio. The functional relationship between the hedge ratio and the outcome of the hedge. If you look at this, if I use a hedge ratio of in the given set of data, if I use a hedge ratio of 0.8, I end up with a net change of minus 200, 0 and 200. Now, if I use a hedge ratio of 1.4, two things happen. Number one, the change in the hedge portfolio goes from 200 to 400, and not only that, the direction of the change also reverses. For example, if the spot price on maturity turns out to be 50 and the hedge ratio is 0.8, I make a loss of 200 units. However, if I increase the hedge ratio to 1.4, I make a profit in this scenario. On the other hand, if the spot price goes up to 70, I maintain a hedge ratio of 0.8, I get a profit of 200 units, 200 rupees, and in similar set of data, if I use a hedge ratio of 1.4, I incur a loss of 400 rupees on the hedge portfolio. So, that is how the hedge portfolio impacts the outcome of the hedge. It is very significant, it is very important that we use the correct hedge ratio. If you do not use, if you do not use the correct hedge ratio, what it means is that we are either overusing or underusing the quantity in the futures market, and because the futures payoff profile is linear, therefore, that is going to influence us both ways. When we are making a when the outcome of the spot price is increasing, as well as when the outcome of the spot price is decreasing, that is what is happening. In fact, the directions of the profits are also reversed in this situation simply by the difference in the or the change in the hedge ratio. This is a continuation of the derivation of the minimum variance hedge ratio. If I set from the minimum variance hedge ratio, what did I get? I got that QF is equal to hedge ratio into QS, and hedge ratio is nothing but beta, and beta can be written as rho sigma s upon sigma f. So, this expression becomes this. QF is equal to hedge ratio into QS. Hedge ratio is nothing but beta, and therefore, QF is equal to beta into QS, and beta is nothing but this expression, the regression coefficient. So, QF is equal to this. You substitute this value of QF in the expression for the variance of the hedged portfolio. Let us go back to that. Let me clarify which equation I am talking about. The equation that we arrived at, if you would recall, is sigma square delta I is equal to QS square sigma square delta S plus QF square sigma square delta F minus 2 rho QS QF sigma delta S sigma delta F. This was the expression that we arrived at using the expression for the variance of a linear combination of random variables. If I use this expression for the variance and substitute QF with this expression, this whole expression, I arrive at this equation. Simplifying this, if you look at this and this are the same, and this is minus 2, this is plus 1. So, I end up with minus 1, and taking this outside the bracket, taking this common outside the brackets, I end up with 1 minus rho square into this expression. Now, it is very clear, it is very obvious that the left hand side cannot be negative. So, the best possible scenario is that the left hand side can be equal to 0. That is the best possible scenario, because we are looking at minimum variance. We are trying to minimize the variance. So, if you are trying to minimize the variance, then and this cannot be negative, the best possible situation is that this can be 0, best possible situation, and that can occur when rho is equal to plus minus 1. In other words, we can create a perfect hedge in a situation where rho is equal to plus 1 or rho is equal to minus 1. That is, the asset which is exposed, or the exposure and the future prices are perfectly correlated. In that situation, you can create a perfect, of course, if they are perfectly anti-correlated, you can also create a perfect hedge. I'll come back to it in a minute. So, the regression equation that we talked about was delta S, dependent variable, is equal to alpha plus beta delta S delta F. Delta S is the dependent variable here, delta F is the independent variable into delta F. Now, multiplying throughout by QS, we get this expression. Throughout we multiply by QS. QS is a real number, it is a number of units of the exposed asset. So, we can multiply this throughout. Again, we can write this expression QS delta F as QS upon QF into QF delta F, simply multiplying and dividing by QF, multiplying and dividing by QF. Now, we want a hedge. Therefore, we want that the total price change in our exposure be annulled by the price change due to the futures position. That is the objective of the hedge, that you want to kill off the price changes in the exposure by taking a price change in the hedge, and that would mean Q s into delta s. This is the price change, total price change of the exposure. Q s is the number of units of the exposure, delta s is the price change per unit. So, this is the total price change. Similarly, this is the total price change of the futures position. So, you want that these two should be equal. If these two are equal, I substitute this expression by Q s delta s. I substitute this expression by Q s delta s and take it to the left hand side. So, what do I get? I get Q s delta x into 1 minus beta Q s upon Q f is equal to alpha Q s. Therefore, in order that the two equations be equal, we want that this expression must be 0, and that gives us 1 minus beta delta s delta f into Q s upon Q f equal to 0, or Q f is equal to beta delta s delta f into Q s, which was precisely what we arrived at earlier. The same expression we have arrived at through a slightly different approach. Now, coming back to that, I just mentioned that the minimum variance of the hedge portfolio can be made 0. Minimum variance of the hedge portfolio can be made 0 if rho is equal to plus 1 or rho is equal to minus 1. Either of the two would ensure that. Now, in that case, when rho is equal to plus 1 or minus 1, our hedge ratio turns to be, which is given by rho sigma s upon sigma f. Rho becomes 1, for let us take the plus 1 case, rho becomes 1. So, this becomes sigma s upon sigma f. In other words, if we have the exposed asset and the futures prices perfectly correlated, the hedging, now this is also equal to Q f upon Q s. The hedging should be such that Q f is given by sigma s into Q s divided by sigma f. In other words, if rho is equal to plus 1, we can still create a perfect hedge, notwithstanding the fact that sigma s and sigma f are different by scaling the quantities of the exposure and the hedge accordingly. I repeat, by scaling the quantities in this of the exposure which is given to us and the futures which we are to determine, we can, if rho is equal to 1 or minus 1 for that matter, we can still create a perfect hedge, notwithstanding that sigma s is not equal to sigma f. In other words, the variance of the spot prices and the future prices are different, provided they are perfectly correlated. Another interesting observation is, let us assume that my rho is equal to 0.8. That means what? That means our hedge ratio is given by 0.8 sigma s upon sigma f. 0.8 sigma s upon sigma f. What does it mean? It means that if the correlation is 80% or 0.8, only 80% of the standard deviation is being used for working out the hedge position in the futures market. In other words, we are only trying to hedge 80% of the fluctuations of the exposed asset, because we know only 80% are correlated with the futures prices. So, the best we can do is to have an optimal hedge with respect to this 80% value of the prices of the exposed asset. the remaining 20% will remain or will continue to be random or will not be annulled or nullified by the hedge. So, to reiterate, if 80% or 0.8 is my correlation coefficient, then the optimal hedge is created by considering only 80% of the standard deviation of the fluctuations in price of the exposed asset, and therefore it also implies that the remaining 20% of the price fluctuations will not be covered by the hedge and will continue to be unattended. Now, we come to the issue of cross hedging. So far we have not accounted for the fact that the hedge may be the futures that are being used for hedging would have an underlying that is different from the asset whose exposure we are trying to hedge. In other words, the asset that constitutes our exposure may not have futures available on them for trading in the market to which the hedger has access. This is a situation which is called cross hedging. Now, when we talk about cross hedging, another factor that contributes to the basis risk comes into play, a factor that relates to the prices of the asset, that is the underlying asset of the futures contract, vis-a-vis the prices of the exposed asset. Let me explain it. For example, let us consider that I want to sell an asset in the spot market and I want to hedge that asset by taking a futures position. The futures that I use for hedging have an underlying asset which is different from the asset that I own, which I want to sell. Then the price that I receive is going to be given by ST. This is the price that I receive in the spot market when I sell the asset that I own or I possess, plus the differential, the profit that I obtain from a short position in the futures market. But note that the futures are created on an asset which is different from this particular asset, and therefore, this asterisk comes into play. This asterisk represents the futures that are created on an asset which is not the same as this particular asset. Now, the profit on the futures position will be created with respect to the actual futures that are there, and which employ an underlying asset which is different from the asset in which you are exposed or which you want to sell. So, this is what you are going to receive on selling the asset in the spot market, and this is the profit you derive from the futures which is on a different asset. I can write this as, by adding and subtracting this expression, I can write it as F0 star, this part, plus ST star which goes along with this. This is an addition subtraction expression, plus this expression is FT star is here, minus ST star minus ST star, and ST is here. So, in other words, by introducing this plus and minus, I am splitting up the price, this is the price, into three parts. One part which is F naught star, the second part which is S naught star minus F naught star, and the third part which is ST minus ST star. What is this? This is the price of the futures when you institute the hedge, when you create the hedge. This is the price that is available in the futures market on the asset which is different from your asset. This is the basis. This is the basis with respect to the actual asset underlying the futures, which is again different from your asset, and this is the difference which arises due to the difference in spot prices between the asset that you own and the asset which is the underlying asset of the futures contract. So, this is a term which comes into play because the two assets are different, ST minus ST star. This is an example which is very interesting. It is 15th October and a treasurer has identified the need to convert euros into dollars, euros to dollars. He wants to convert euros to dollars to pay a US supplier. He has imported some goods from the US and he has to pay the US supplier US dollars 12 million. US dollars 12 million on 20th November. Today is 15th October. He wants to make the payment on 20th of November of an amount of US dollars 12 million. And he is a person or the firm is domiciled, is a resident in a country where the home currency is euros. The treasurer has decided to use December euro futures. For this purpose, he opens a position on this date and closes it on 20th November when he lifts the hedge. Relevant spot and futures prices and others are given below. The contract size is euros, this thing. This is the contract size, this is the lot size. The prices are, we need to keep track of the manner in which the prices are quoted. Spot prices are quoted in terms of US dollar euros, futures are also quoted in terms of US dollars per euro, US dollars per foreign currency per unit of home currency, that is 1.33, and this data is given to you. Calculate the net price paid by him on the entire US dollars 12 million after implementing the futures hedge. Now, the amount that he has to pay is 12 million. He normally, because he has to pay US dollars, so he would have required to buy US dollars from the spot market, and therefore, he would have taken a long position in the futures market to protect him against a rise in price of US dollars, a long position in US dollar futures. But it is equivalent to taking a short position in euro futures. So, this is the lot size. Now, let us see analyze this is the data that is given to us. The amount to be paid, this is as on this particular date, that is on October, it was I think 15th October, 15th October, this was the US dollars divided by the spot rate US dollars per euro, this gives you the amount to be paid in euros. Now, this is the amount to be paid in euros. The contract size is 200,000 euros. So, the number of contracts works out to 45.1128, and that is rounded off to 45 contracts. This is the number of futures contracts that he is taking and that is taking a short position in. Now, we look at the situation how it evolves on November. Now, in November when he makes the payment in euros, how much payment does he make? He has to make a payment of this amount, and what is the spot rate in November? The spot rate in November is 1.3190. So, his payment is this amount divided by 1.3190, which is the spot rate in November. This is the actual payment when he purchases from the market and he gives to the US dollar supplier. But he makes a certain profit on the futures, that short futures position that he had taken. How much is that futures position benefit in the futures position? The change in price is of the futures is from 1.3350 to 1.3240, and his position is short. So, and the number of contracts is 45. Therefore, the profit that he makes in US dollars on the futures contracts, he has a short position in euros, euro futures, he has a short position in euro futures. The profit that he makes in US dollars on these short euro futures, 45 short euro futures, is given by the difference of this multiplied by the number of contracts, 45 into the contract size, which is 2 million, 2 lakhs, that is 200,000 into the change in price. This is in US dollars. This is converted to euros at the spot rate, which is given as 1.3190. this gives you this much profit. This is the profit on the euro short euro futures position, and this is the net amount, therefore, that he makes the payment against his liability of this dollars. Thank you.